I'm Howie Lim. This is Money Hacks by the Business Times. All right, so we've waved goodbye to Q1. Are you happy to see the back of it? Wished you'd done more or less, or what's going on with your portfolio and money? Let's find out how we can turn things around if Q1 hasn't treated you too well. Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim. And if you have feedback or an idea for a podcast episode, do get in touch, btpodcasts@sph.com.sg. And helping us out today, David Kuo from The Smart Investor and Chung from Endowus. Hello.
Good afternoon, good morning, good evening.
Good morning.
And good night. Goodbye. Maybe you could help me out. How has Q1 been doing, markets in Q1?
It's been volatile, and volatility is one of those things that scares a lot of investors. But my personal view is if you know what you are invested in, then volatility is an opportunity rather than a threat. There's nothing to worry about in terms of share prices going up or going down. As a long-term investor, I would much rather share prices go down than to go up because I'm constantly investing in shares. So the lower share prices go, the better it is. But other people may take a different view. I mean, Hugh might take a different view.
Do you, Hugh?
No, I take my view is very similar to yours, Dave. And, Q1 was volatile, but it's also important to know that there's been a divergence in performance. Europe is actually doing very well from a stock price perspective. The Hong Kong market is up more than 20%, HSCEI. And then there are various commodities like gold that are doing really well as well. So the performance has been very diversified. A 60-40 is actually flat for the year. So despite all the volatility, it's not as dramatic as some people may portray to be.
Have you seen people make mistakes, though, that they should have avoided? Because at the beginning of the year, we were told curb your enthusiasm a wee bit. Have markets shifted, say, since Trump? And were there mistakes made that you saw?
I think it really depends on what the reason for you to invest is. As an income investor, I am in the market to buy dividends. If share prices are high, it costs me more to buy that dollar of dividends. If share prices are low, it costs me less to buy that dollar of dividends. But ultimately, I will be in the market to buy dividends all the time. The biggest mistake people can make is to say, oh, I'll just wait. I'll wait for something more concrete to happen first before I step into the market. Well, how long are you going to wait? I mean, as Hugh said, there are different sectors of the market. So whilst America may be down, China is up. So what are you waiting for? As an investor, what you need to do is to have a very diversified portfolio. And so there are always opportunities there for me to go into the market and buy. And what I'm looking for is good, cheap stocks that I can buy. And all of those stocks have to reward me whilst I'm owning them. In other words, they have to pay a dividend. And if you listen very carefully, Howie, another dividend check just dropped into my bank account.
I did not hear anything.
I did. And that is the reason why I invest. And I think if people don't know why they're investing, then, of course, volatile markets can become very frightening for them.
I think I agree. The volatility, uncertainty is the new normal kind of. When is it ever certain or not volatile, right, Hugh?
Yeah, absolutely. So if you look at the volatility index, which is represented by what we call the VIX, which is the volatility in S&P, it's been at a very, very low, I would say unsustainably low level for a pretty long time. And that's kind of recently spiked up to a level which is higher than before, but on a very long-term history basis, it's not alarmingly high. So I think there was a lot of complacency in the market. And going back to your question on what's the mistake that people have been making in Q1, it's the notion that good things last forever. You concentrate your positions into certain sectors and certain countries, and that kind of expectation has led to people trying to react to certain things. So one of the questions that we get a lot from our clients now is that, I know you said you shouldn't time the markets, but should I just get out and come back at some other time? So this kind of notion to time the market is also coming from a portfolio construction that is too concentrated. So I would say that's probably the biggest mistake that people make in Q1.
And they're still doing it right now?
I mean, not everyone, but there are groups of people who are. And that notion is that I am capable of reacting and getting myself out of this situation. where in reality, a lot of the times the market actually prices in a lot of these concerns ahead of time. And if you're selling now, you're assuming that things will get even worse than what's priced in. Now, you could be right, you could be wrong. Even if you're right, a lot of times people are not able to get back at the right time. And so even if you're right on the selling, you may not be right on the buying back. So a lot of times being reactive is not a great strategy. So if you feel like your portfolio is too risky for you, then you can reassess that holistically. But it's never good to kind of react to a certain situation.
I mean, Howie, there's an old cheesy saying that it is time in the market rather than timing the market.
We should play a drinking game. How many times people say that, yes?
But it is absolutely true. I mean, people say, oh, is this the right time to go into X, Y, and Z stock? And I say, well, ask me in 10 years' time. Ultimately, that is what you really need to do. You are investing for the long term. Is this bank expensive at this point in time? Look back 10 years and say, would you have gone in 10 years ago into this particular bank? 10 years later, I wish I had. Should have, could have, would have are three words that people say quite regularly. I should have done that. I could have done that. I would have done that if. Ultimately, what you need to do is to say, what is my time horizon for investing? If your time horizon is only a week, you're a trader, you're not an investor. I'm an investor, and I will say, yes, every day is a good day to go into the market, because ask me in 10 years' time, is this bank overpriced? And the answer is probably not. But during that period of time, if you are rewarded for holding those shares, in other words, you're receiving dividends, you take those dividends and you just plow it back into the market again. And it is the compounding that actually gives you the kind of returns that you require.
We're always told not to listen to the noise, but then again, you can't be blind to everything, right?
Turn the radio off, right?
Dang it.
I'm sorry to say that, but
Preaching to the choir here.
just tune out completely. One of the biggest noises at the moment is what is going on in America. But let's not forget that this will only last 4 years. And if you're going to be investing for 40 years, it is only 1/10 of the time that you're going to be in the market. And I look at what is going on in America, and I just think everything that he is doing is not right. But there's nothing that I can do about it. So as Hugh would say, look somewhere else. Let's not forget that America is a population of 300 million people? How many people are there in the world? 7.6, 7.7 billion people? And I think the rest of the world is beginning to realize this, that if a company is reliant on sales to America, well, that's not a great company. A company should be able to sell to the rest of the world. And if you are reliant on those 300 million consumers in America, you're ignoring the other 7 billion people out there that you could sell to. So if America wants to slap tariffs onto companies that export their goods into America, those companies should look for other markets. And if you are a believer in capitalism, those companies will, Howie.
So don't listen to the noise. You reckon maybe that's advice that people are still not heeding, Hugh?
I absolutely agree. I think people should tune out. Okay, not completely, but generally speaking. And the reason why people can't do it, because they're nervous about their portfolio and so on. And so it goes back to the point of, I'm not sure what I'm holding is the right holding for me. And if I did the work properly, if I know about my risk, if I diversify my portfolio correctly, you wouldn't be as worried. So it's situations like these that are reflective of how matching your portfolio is to your goal. Because if you're very confident about that, you wouldn't need to worry about every tweet, et cetera, et cetera. And going back to what I said, the more concentrated it is, let's say I have only exposure to one stock and something happened to that stock, there was an overnight news, I need to follow it because, the consequences are large. So it really, really is reflective of the kind of portfolio construction and the way you've thought about it. And if you did, then you should tune out, right?
But people can't ignore train wrecks. That's the problem.
They can't help themselves.
They can't help themselves. I mean, people have to rubberneck when you see a train wreck. When you see a car crash, you have to go and have a look. And what you need to do as an investor is to say, tune out, focus on the road in front of you. Otherwise, you're going to be part of that train wreck. You're going to be part of that car crash. So don't look at what's going on the other side of the road. Focus on you and your long-term goal. And as Hugh said, if your long-term goal is to I don't know, achieve $1 million by, 2050, 2060, well, that is your path. That is the path that you need to go on. And
in essence, stay in your lane.
oh, precisely. Because if you're going to be distracted, then you're not going to be able to achieve your goals. And have a diversified portfolio so that you are not reliant on just one stock. You are not jumping up and down on a pogo stick because that never goes anywhere.
Hold that thought. So you've made some mistakes. You've lost some money in Q1, but not all's lost, I'm sure. We're coming back with David Kuo from The Smart Investor and Hugh Chung from Endowus in a moment.
Lens on Singapore is now bigger and better. The same deep dive exploration of socioeconomic and geopolitical issues which impact our lives here in Singapore and the region is now a video podcast. If watching a conversation is your thing, join Claressa Monteiro in monthly conversations about things that matter. Subscribe to the BT Lens On playlist in the podcast tab of the Business Times YouTube channel and start watching today. BT Lens On Singapore, now available in audio and video.
And now, back to Money Hacks from the Business Times.
Do you think it's possible to turn things around now? Let's say an investor was somebody who was listening out for David's checks dropping into his bank, was listening out for all of this stuff that was going on, and now wants to get back on the straight and narrow.
Of course. I mean, but you have to start today. And if we listen again tomorrow, there'll be another dividend check dropping into my bank account tomorrow and the day after. I mean, my portfolio is constructed in such a way that there is almost a dividend check arriving in my bank account every single day of the week. The only times I'm a little disappointed is on a Saturday and a Sunday because the banks are shut and the dividend checks don't arrive in my bank account. But
I wish you could see this. Hugh is shooting David dirty looks.
No, I was going to suggest that we go out for lunch or something with the dividend check that's coming into your account every day.
And that is the beauty of dividend investing, Hugh, because ultimately you can decide what you want to do with that dividend check. If you want to take that dividend check, go out and buy yourself a new suit, you can. But in my case, I try and reinvest those dividends because that is what investing is all about. It is about compounding. And going back to your question, is there anything that people can do now? The answer is you need to start investing now, not wait until tomorrow, because tomorrow never actually comes. Sounds like a movie, doesn't it?
No, I was going to just add that I think it's easier for people who, let's say, have stayed out of the markets and just wondering when to come in, follow your rule, start today, right? I think it's harder for people who, let's say, may have gone through FOMO last year, put some money in, and they're kind of in the red. What do I do? Do I wait? Even for those people, I would suggest you really reassess whether your portfolio is right for your goal. Set your goal first. And if it's not, then whether you're in the red or black or what have you, you have to make that decision. Those are the harder decisions to make. I think it's easier if you're kind of have a lot of cash and fixed D and whatever and start investing today. But yeah, I mean, so the answer is yes, we can start and we should. It's hard to, I know, for certain people. You don't want to lock your losses, et cetera. But it really has to do with getting your goals right and then setting up that portfolio that's in line with your goals.
So you don't shoot the messenger. How are things looking going forward?
I think it's going to continue to be volatile, which therefore means that if you're waiting for the volatility to subside, then you're going to wait a very long time because volatility is always going to be there. If it is not what is going on in America now, it'll be something else. There will always be something else that will create that volatility. If you're waiting for the perfect conditions, then it probably means that share prices, stock prices are going to be too high. So what you need to do is to say, right, these are the kind of stocks that I would like to buy. And I'm going to buy them. And this is where I disagree with you slightly, Hugh, about your portfolio being underwater. It doesn't matter.
Oh, that's what I meant. It doesn't. That's why some people care, but you should start.
But you shouldn't care. I started a portfolio about 4 years ago, and I bought a bunch of Malaysian stocks. And I remember at the time, a lot of people said, "You're crazy, David, going into Malaysia." And I said, well, my reasoning is correct, that I believe that these stocks are undervalued. And sure enough, for the first couple of years, the portfolio started to lose money in the sense that the share price continued to fall. But eventually it turned around. And today the portfolio is in the black or in the green. In other words, it is making money. And so you have to say, what is my long-term horizon? But during those 4 years, I was still collecting dividends and the money was being just plowed back in. So you have to believe in your principles.
Just to clarify, what I meant was, if it's not what you were supposed to do in terms of your goal, then you should change it regardless of whether it's in the money or not. But if it is, then you're right. I mean, it doesn't matter out of the money or not, you should keep it, right? So my focus was more whether you set your goals correctly. And if you hadn't, whether it's in the money or not shouldn't impact your decision. But for a lot of people, it does.
But it shouldn't.
That's what I mean. I agree completely.
But it shouldn't.
I agree completely. But just on the outlook as well, I would agree that volatility has been too low. I think this new era, so to speak, of higher geopolitical risk, as well as globalization going into regionalization, all that kind of stuff will continue, which means the market is more uncertain and it's going to stay volatile. But that doesn't take away the fact that you should continue to be invested in the markets. And if you look at the outlook in the US in particular, what's happened recently is growth has been repriced down to something that seems less optimistic. And again, that's part of the economic cycle that we've been seeing thus far. So it's nothing out of the norm. The outlook is probably less optimistic than it was maybe a year ago. But again, that doesn't change anything over a long period of time.
And I think one thing that people need to be aware of, Hugh and Howie, is inflation. I do believe that inflation is going to be coming back for all kinds of reasons. And I think if you are not invested in inflation-beating assets, you are going to be disadvantaged. So if you think, oh, I'm going to sit back and wait for the right time to go into the market, that money that you're sitting on is losing its purchasing power. And so it is vitally important that you find inflation-beating assets. And I think what is happening in America is going to drive inflation. It is going to drive interest rates higher. Because it is going to be higher in America, I think the rest of the world will find it very difficult, even if their economies are slowing down, to think about cutting interest rates, because that interest rate differential between America and the rest of the world is going to widen, and it's going to make things very difficult for people, Howie.
So that's the one tune we should be listening out for, not noise, the interest rate path, inflation.
It's not just about inflation, it's the growth that gets impacted by inflation as well. Inflation can very well remain sticky and growth can very well, go down as well. But that's why it's so important to have that diversified portfolio. But when you look at inflation, people tend to think, oh, the best thing to do is just have it in cash because everything else is going to be volatile. But if you look at what equities are collectively, it is really a sum of the public listed corporate earnings. It's a margin after or it's post cost of corporate revenues, which is nominal, which includes inflation. So actually, one of the best ways to protect inflation is to be invested in a globally diversified basket of equities as well. Inflation can remain very sticky for a long time for a number of different reasons. It doesn't mean that you should stay out of the markets, right? It actually means that you should be invested in various assets.
And you should be invested in those companies that have pricing power, Howie. Those companies that have the ability to raise prices. I don't know about you, but I've noticed here in Singapore, a lot of places I go to, I used to be able to buy a bowl of mee pok and a cup of tea for $5.
Where?
When I went, I'll tell you after the podcast. Well, I went recently to the same place. It's gone up to $5.30. That's a 7% increase. How did he manage to do that? Because he can. And if you want to buy it, well, you're going to have to pay $5.30 now. I gave him $5 and he looked at me and he says, where's the 30 cents? So embarrassing. But in any case, what I am trying to say is that inflation is around and the $5 that you had in the bank is not going to be able to allow you to go and buy what you want to buy anymore. You've got to invest in. I should invest in this company that increased their price from $5 to $5.30. But I think you get my point, that inflation is going to be around for a while.
Roger that. I wish we had more time. David Kuo from The Smart Investor and Hugh Chung from Endowus. Thanks for your insights.
Thank you.
Thank you.
Next time, is cash still king? Are there better cash management solutions to get your cash to work for you since interest rates are falling? Join us next week to find out. I'm Howie Lim. This has been Money Hacks from the Business Times.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.